you're welcome to episode 2 of the Forex Mentorship. So today we'll be talking about what is PIP, loss size, margin, margin call, equity, and leverage. So these are just basic terms which we make use of as Forex traders in the financial market. The pips measure the distance which price move in the financial market. So it's a very simple term. If price moves from point A to point B, so in the financial market, we usually measure it in form of what we call pips. So we can know the distance between price or a currency moves. So it just talks about, like, for example, we have this point now, this point A, from this point to this point. So when we measure it, we're measuring it in what we call pips. Now, to get a pips is very simple. So there's what we call points. So points is what creates pips. And to get one pip, we need 10 points. So for example, we can say for pips, to get one pip, we need 10 points. So we can indicate it here. We need 10 points. We need 10 points. Example, if you want to get something like 10 pips, if you want to get 10 pips, so that means you need 100 points. So let's indicate it here. For example, if you want to get 10 pips, that means we need 100 points. The calculation actually will not be done in the financial market nowadays. You will not have to go through this stress of calculating pips. There are tools which you make use of, and it will just show you how many pips the market has already moved. So, but this is just for you to understand the fundamental principle of how it is being formed and used. So nowadays, they don't usually calculate pip manually again. So just looking with some tools I'll show you, you'll be able to just calculate your pips and know your pips in a glance without even wasting any time. So let's talk about the next term, which is lot size. Lot size, it just means a volume which we use in trading in the financial market. So this volume or this size can be measured in three ways. We have a standard lot. We have standard lot, standard lot, we have the other one which is called mini lot, mini lot size, and we have another one which is called micro lot size, micro lot size. So these are the three lot sizes in the financial market, in the forex market. So we have standard lot, we have mini lot, and we have micro lot. So let's differentiate them. For example, a standard lot is anything around 1, 2, 3, 4, 5. You can see a number that starts from 1. The beginning, the first number has to be 1. So this is the first way it can look. And another way is something like 1.2. Something like 1.3. All these are standard lot because the first number is starting from 1. Then before you can see the points down. So the next one which we have here is the mini lot. For a mini lot, the mini lot starts with something like this. It starts with 0.1 to 0.9. So this is the mini lot. Then the micro lot, it starts with 0.01 to 0.09. So this is how it is. So for standard lot, anything around 1 lot, 2, 3, 4, 5, all those are called standard lot. Something like also 1.2, 1.3, and so on and so forth is called a standard lot. And this 1.2, 1.3 might also be something like 3.3. Anything just around those stuff are called standard lot. Why mini lots always start from 0.1 to 0.9, and also there can be other figures around it. For example, we might have something like 0.12. So this is still a mini lot. So let me put the points. So we have 0.12, So this is still a mini lot. And also we have the last one, which is the micro lot. So the micro lot is the smallest lot size. So but before they usually there's another type of lot size, but due to what we call leverage, is no longer in existence. We usually call it the nano lot size. We call it the nano lot size, but it's no longer in existence. So, so these are the three lot size you will make use of in trading. So either you're making use of the standard, the mini, and the micro lot size. We can liken this to also in our real life scenarios. For example, we can take the standard lot, for example, to be a bag of rice, and we can also take the mini lot to be a half bag of rice, a half bag of rice. And we can also take the micro lot to be a cup of rice, a cup of rice. So these are just the way of differentiating the standard, mini, and micro lot size. So this is just how it is. So the next one we'll be talking about is what we call margin. So the term margin is a very, very important term in the financial market. So what does margin simply mean? So margin talks about the amount which your broker wants you to have before taking a trade. The amount which your broker wants you to have, wants you to have in your account, while taking trades. While taking trades. Let's say, for example, your broker, which is your agent in the market, wants your account to be safe and to not be below 80% of your account. What it simply means is that, for example, if you have $100 on your account, your broker wants that $100 to be safe and you should not lose more than $80. You should not lose more than $80 per time. So that's just what it means. So your broker wants you to be above $80. So that's your margin. So when we say margin, just that's your level. That's the level which the broker wants you to sustain for you to participate in the market. So when you break this threshold of $80, your broker then gives you what we call a margin call. So it's a call for you to add up to your account, or you have breached the contract between you and your broker, which your broker needs you to be above 80% of your account. So immediately your account goes below 80%, they give you what we call a margin call. It calls you to inform you that you have breached the contract. So that's just what margin call is. So let's go into the next term, which is called equity. After this class, the next class will be more technical and will then be diving into more concepts in the forex market, which will be able to help you in trading and also profiting from the financial market. So let's talk about what we call equity. Equity simply means balance plus open position. So this is just what equity simply means. It means your balance plus open position. What do I mean by open position? Let's say, for example, your balance is $100 and you're in a trade and you're in a profit of $50. Now your equity becomes $150 while your balance is just $100. But because the running trade is called an open position, so your equity, it merges both the balance and the open position. Also, if you're in a loss of $50 in $100 account, your equity then becomes $50. So it either adds or it subtracts from your open position, from the balance also. So that's just what equity is. So equity, it means you're either adding the balance to your open position, or you're subtracting your balance from your open position. Those are the two scenarios. So let me just write it. The first scenario comes into play when you are in profit, and the second scenario comes into play when you are in loss. So that's just what equity means. Equity simply means balance plus open position when you're in profit, and also balance minus open position when you are in loss. So you understand better when you start trading. Is a very, very simple term. It's a very basic term that you even most likely not be making use of. So it's just for you to have an idea of how it works. So the next thing we'll be talking about is what we call leverage. Leverage is a loan given to you by your broker to assist you while trading. Is a loan given to you, or an assistance given to you. So when we mean leverage, leverage simply means assistance or help. So that's what leverage means. For example, if a bank gives you a loan, is also called is leverage. For example, if you're traveling from a point A to point B, you make use of a car. The car becomes what? A leverage for you. Also in the financial market, also you need a leverage which the broker offers you. So there are so many types of leverage which brokers offer. We have something like, in the financial market, we have something like 1:100. We have something like this, 1:100. So when we mean 1:100, it simply means for every $1 you have, your broker will give you $100. That is just what it simply means. For every $1 you have, your broker will give you $100. Another one is something like 1:200, and we have 1:300. We have 1:300, and so on and so forth. So this is just how leverage is. So when you're creating an account, you will see what we call leverage. Without leverage, the retail traders won't be able to trade in the financial market, because you need very huge capital to trade in the financial market. Without leverage, you need something like up to $100,000 to $1 million minimum for you to even open a position in the financial market. But with the aid of leverage, your brokers now are able for you to get into the market with as low as $100. You'll be able to trade in the market. Even $10, you'll be able to trade in the market. Thank you for staying to the end of episode 2 of the Forex Mentorship. Please like, comment, and subscribe.